but continue to be range bound. So let's chat with Manish Sonthalia and find out what is it that you should be doing in this market. Manish, hi, good morning. Great to have you on ET Now. Thanks once again. Manish, how do you make peace with this range-bound kind of market? I mean, there are so many push and pull triggers, but the market is just standing in that one band at an index level, of course.
Yeah, so basically, markets are waiting with bated breath for earnings to revive. 6-8% earnings growth, this 24-25,000 levels do tend to look full. But as I have alluded to in the past, that, given the rate cut cycle that we are in, further rate cuts cannot be ruled out. One coming in October, and on the back of Federal Reserve. Again, that could be a virtuous cycle of rate cuts that could happen in India also. And markets would tend to overshoot. So, yeah, the markets are range bound. And I think the range is a large one between 24,000 and maybe 27, 28,000 for the next 6-9 months. That should be what should be expected. But markets are waiting with bated breath on the earnings front.
But Manish, because of the GST rates getting implemented only on 22nd, we know that at least the consumption piece will have a delayed earnings revival, right? It's not going to be in the quarter ahead. It's going to be one quarter later. Where within the earnings pool do you actually see a meaningful revival kick in this quarter's earnings?
No, so October quarter is going to be similar to what the June quarter was. One is building in revival in earnings in the second half of the year on account of the fact that, first of all, you have consumption impetus coming in from the government in the form of, let's say, income tax cuts. That also is likely to play more towards the second half of this year, plus GST, plus, going forward into the next year, we're also looking at pay commission recommendations, helping the consumer basket. So market has priced in some bit of that consumption revival, consumption boom already, but more to come. But as I've said that, the 6-8% sort of a trajectory on the earnings front, like we saw in the first quarter, is likely to persist even in the second quarter. And thereon, you'll see the heavy lifting, partly on account of the fact that the last year's second half base is quite low. Plus, we have a whole lot of, policy measures kicking in on the rates front, on the fiscal side, on the taxation benefits, etc. But consumption, capital markets, infrastructure, insurance, banks, more so the public sector banks, you are looking at even IT on the valuation front, not so much on the news flows front, but it's also a buy. And I would tend to believe that even pharma CDMO, the outlook looks pretty promising. So these would be some of the sectors where things would look good. Earnings revival continues for your capital good related thing, but there the problem is valuation, nothing more than that.
Right, Manish, hi, morning. This is Snehi also joining in. So, in a market like this, you just spoke about how quarter two earnings could mirror that of quarter one. But what about beyond? Because the festive season is underway and we could see that pick up the sales of some of the staples or discretionary autos like you were just talking about. Do you believe that this could finally be the trigger that could get the market out of a lull, or would it rather just be a wait and watch sort of an approach right now?
No, it's not a wait and watch. It is a buy on dip only. Valuation is likely to expand on falling rates. That is one. Secondly, if Nifty 50 earnings growth for the first quarter was 8%, and similarly, if you're building in, let's say 6 to 8% sort of an earnings growth for the second quarter, and the full year earnings growth for FY26 is likely to be 10-11%, then the second half is likely to be something like 12-13%. And if markets basically are waiting with bated breath to see that revival in earnings from 8% to 12-13%. If that happens, definitely we think that there is going to be a floor to the market fall, and things should revive from there. More so on account of the fact that consumption related themes, obviously a lot has been talking about it. It's starting to get priced in as well, but investment-related themes will give way to consumption-related themes. That's the big heavy lifting on the earnings. That's likely to come from there. the momentum continues on the earnings front from players like power, renewables, defense, not so much defense, but renewables and power transmission and all those investment related things. But the main problem is not the earnings per se, but valuation. Yeah. So answering your question in short, the heavy lifting of the earnings is likely to come from consumption going forward.
But Manish, consumption doesn't have that kind of a weightage to reflect on the overall markets, right? Else, of course, otherwise you're looking at NBFCs as well, part of that route, which is going to instill consumption.
Yeah, absolutely true. Around 50% of the Nifty 50 is basically banks and IT, and not 50, but maybe 45% or thereabouts, and banks, NBFCs, and IT. So I think which is insurance, is likely to see very good growth. Banks will project on similar lines, like 8 to 10% sort of a growth. And, public sector banks are likely to see bigger earnings delta going forward. And, headwind is there for the IT space, but the rest of the 50% is where the earnings growth will come from. And this would include a plethora of sectors. You have consumption, both staples and discretionary, because rural economy is also turning the corner. That is one. You'll have construction. That is also going to be the other. So it's a whole lot of sectors to pick from. Chemicals is turning the corner, so on and so forth. So yeah, both discretionary and staples will have to do the heavy lifting. Going forward on this 6.5% real GDP growth rate and 10-11% sort of nominal GDP growth rate. But the pendulum is definitely shifting away from government-induced capital expenditure, which gets capped at 11.3 lakh crores. And given that the revenue collection can only be that much on 6.5% sort of real GDP growth and let's say 9% to 10% nominal GDP, you can't expect revenue collection to be more than 11-12%. That's already got built in. So there's also a limit to what government can spend. So it's a mix of many things, but at the margin, things are moving positive for the consumption, and the heavy lifting on the economic growth will shift away from investment to consumption is what I think is likely to happen.
Hi Manish, morning. This is Shrishti also joining in. So interesting take when it comes to government expenditure. But Manish, the other theme that is seen to be once again picking up is actually the whole data center theme. And therein the whole lot of private participants are seen to be interesting. Some reports are also suggesting that India's national draft policy is also proposing a 20-year tax holiday. Just wanted to understand if at all you are analyzing or looking into this particular theme. Are the investors at all interested in the India growth story, and are there any investable opportunities?
Yeah, a few names are there. Wouldn't like to name them, but yeah, they look quite interesting from the point of view of the opportunity set in data centers. The guys who are basically building the infrastructure and managing the data center on a plug-and-play basis. Those look good, and obviously the icing on the cake would be when government gives, or if the government gives a 20-year tax holiday. That's only going to boost earnings. But ancillary to the data center play is basically your battery energy storage systems, BESS. We haven't even started. This whole theme can become quite big, and it's very important for the data center to have a BESS systems in place, generators, engines, the guys who make engines for the generators, so on and so forth. So there are opportunities in specific places as well as ancillaries to this. But one needs to be just watchful of valuations. The valuation is just quite extraordinary in terms of the fact that what are you pricing growth and how many years of growth are you pricing? Because there will always be execution challenges that you'll have to build in that growth. So, one has to take a call on that, and opportunity set looks quite big, that's for sure.
Interesting, and always good having you on the show, Manish, and speaking with you.
Thank you.
Okay, let's switch focus from equity market.